So, this is the PE ratio breakdown video. So, it's the first of a series of videos to improve your stew pot of food. So, little food metaphor here. So, if you're making a stew, you're going to have vegetables, meats, potatoes, that kind of stuff. A lot of different parts of a stew. So, of all the parts, if there's a beef stew, this is the beef. It's one of the most important things. For a toolbox, this is your favorite screwdriver. One of the absolute most important things that you need to know if you want to get into individual stock picking. So let's begin here. So, what is a PE ratio? Now, PE ratio itself is the price per share over the earnings per share. Very, very simple. It's a ratio. But you have to understand the ratio and how it can help you. Now, there are two main types of P ratios. There is trailing 12-month averages and forward EPS based ratios, so a forward PE. Both of these are very, very important. Forward PE, TTM. The trailing 12-month gives you an idea of how the company has done the last 12 months. Reality, very, very useful. But drawback is that past performance is not indicative of future results. That's not really true. Past performance is very important for future results as well. But you don't want to just look to the past. Now, a forward PE is very, very useful because it uses the earnings per share the company expects to get. So companies will actually say, hey, this is the EPS we're expecting, the growth rates we're expecting for next quarter, annual, up to 5 years. Oftentimes, if it's up to 5 or 4 years, you're kind of going to estimate and use forward projections based on the 1 year growth ratio. But it's important to have an idea of the future of the company. So both of these are very, very important. You use both of them. The TTM is often more realistic. The PE is gold. And the forward PE allows you to really make sure forward leaning EPS is accounted for. They also have PEG ratio, which I'm not going into today, but PEG ratio is similar to a forward PE, where it would be a forward PE divided by growth rate. It's also a pretty useful metric. Don't use that one too much because you can technically just use a 2 or 3 year PE by using what's expected as 2 or 3 year EPS numbers. So, what is better, trailing PE or forward PE? Now, once again, you really want to have both of the two be used. So, that's important. The past and the future are all going to merge into a stock price and how a company is going to actually perform. The only thing about this slide that's worth mentioning is that I like the bottom part. I'm not a huge fan of where Yahoo Finance has like 5 year PEG ratio. It's very, very hard to predict how a company's going to do 5 years from now. But I do like how 1000x.com and other sites will give you a 2 year PE. That's pretty useful. That can actually mirror reality. But it's very, very hard, in my opinion, after 2 years from now to really be confident of what's going to go on with a company. All right, it's a very, very easy example because it's just a basic ratio. So if a stock is currently trading at $100 per share and it's expecting EPS of $5 per share, what are we dealing with? Okay, first we're doing a forward PE because it's expecting EPS. If you're expecting, you know it can't be a trailing 12-month PE. It's not possible. Then all you do is you have the 100 divided by the 5, you get 20. So in this case, the forward PE is 20. So how do we make the PE ratio useful? Okay, so it's important to, one, think of the sector. You have to compare the ratio to other companies in the exact same sector. because sectors have wildly differing P ratios. If you compare Meta to a Chipotle, for instance, going to be different. One's a restaurant, one is one of the biggest companies in the world, and an actual tech company. Likewise, you have to differentiate between growth versus value. A growth stock is going to have a much larger P ratio than a value stock, usually. Value stocks, regardless of industry, usually between 0 to 25 P ratio. A actually fairly balanced stock and well priced could be up to like 50 P ratio and still actually be okay buy as a growth stock. So it's very important to differentiate the growth rate of the company and know, am I dealing with a healthcare stock, big pharma, tech, oil, etc. All very important. So a couple options to get really good peer comparisons. Most brokers will have an actual peer comparison option, and I think of all the brokers I use, Charles Schwab, Webull, E-Trade, I like Webull's the best for here because they will actually have an option where you can pull up the comparisons for an entire sector. So the only thing about this that's very, very important to realize is they will grade based upon the highest P ratio. And for them, the highest PE in that sector is going to get run the number one grade. In reality, that isn't a good way to do it because that stock is usually heavily overvalued. So in the case of the restaurant industry, and even the restaurant industry is further divided. So these kind of represent the fast food that is still food category. So here you have Cava, you have Wingstop, you have Dutch Bros. Actually food. You don't see McDonald's on here, for instance. So these are food. Chipotle's on here again. Not like the typical carcinogen heavy fast food. But in this case, Webull is probably wrong here. They're advertising a PE of 630, which is wild. That is very overvalued stock. But to rank number one. So, like anything else, you have to be able to get all this data and then differentiate it for yourself. So that's very useful. And this is also why I have such a massive short on Kava right now. Because I can tell it's overvalued. It might take a couple weeks to get where I think it should be, but it was an easy decision. Now, websites like fullratio.com here do a very good job of showing you a wide variety of P ratios. So just pulled up this website. It's this for forward P's, but I'm able to get a good feel quickly of all the major sectors and the actual P ratios for them. So pretty easy, very important. And remember, oftentimes a good buy is a P ratio a little above the average. And then that's not necessarily overvalued. Just overvalued when it's crazy above it and you can't justify it even on earnings. So this is one tool in a toolbox. Be careful using it by itself. Next, so this is a cool website. It's 1000xstocks.com, which is not available for you yet, but you probably can access it in 2025. This is Jeremy's website he built. He's a founder of the Financial Education YouTube channel. I like this website because it gives you 2-year forward P's. It's very, very useful. So you can just instantly see the 2-year forward PE. What I say that's a problem with this website is I don't like the many stocks trade at part. So he's kind of going over stocks in general, and this portion is not well divided by sector. But once you can access this website, it's very useful at providing you these nice 2-year forward PEs. Otherwise, you're often stuck using a PEG ratio, which is fine. There's one more step for you. In finance, a lot of the game is trying to get as much information as quickly as possible because there's so much stuff to do when it comes to trading. But some closing thoughts. So limitations versus advantages, and these mirror each other. So, for instance, once again, you can't use a forward PE to dictate your decision on how the stock has done in the past. That's what the TTM is for, and vice versa. So make sure you're using the correct one, and don't like confuse the two. So you see so many ratios, it's very easy to accidentally pick a TTM PE when you meant a forward PE. Another important part here is, I've said this before, you have to use all the tools in your toolbox. So insider trading, I love insider trading, but I don't actually just purely mirror what the actual congressmen do. Sometimes they're wrong as well. So that's a tool. MACD history is a tool. RSI is a tool, etc., etc. Don't just use P ratios by themselves. So a big advantage to the P ratio is a risk management tool. So this can get you out of trouble where oftentimes the best decision you can make and what will keep you making a lot of money is just sitting on the sideline. By sitting on the sideline, you avoid getting into trouble, and you can make sure that when you do get into a situation, it's very favorable. So that's a P ratio video, pretty short and sweet, but hopefully this kind of makes it make more sense for you and use it more advantageously in the future. Have a good one. Bye.